All right. Hello, everyone, and thank you all for joining us today. Today, we're excited to dive into one of the most important milestones that many founders, executives, families, individuals will ever experience, a liquidity event. My name is Adam Sandler, and I am a senior principal with Cerity Partners Family Office. I lead our advanced planning practice, working closely with families on estate, tax, and business succession strategies. Before we kick things off, I want to introduce you to my colleagues here who are here with me. First, we'll turn it over to Justin Valesco.
Thank you, Adam. Hello, everyone, and thank you all for attending today's webinar. My name is Justin Valesco, co-head of the Cerity Partners Family Office. The Cerity Partners Family Office is a group within Cerity that focuses on providing ultra-high net worth individuals and families with high-touch, specialized family office services. I'm a tax attorney by training, so we're often working with clients to come up with unique tax planning strategies that are typically tailored to their specific needs and objectives, with these strategies really spanning multiple disciplines, including trust and estate planning, income tax planning, insurance planning, charitable planning, and more. It's really at this intersection where we're able to craft some of the most powerful plans, and we're looking forward to sharing some of them with you today.
Thanks, Justin. Next up, we have Andrew Cooper.
Hi, everyone. Very nice to meet you. I co-head the Cerity Partners Family Office with Justin, working with some of our largest and most complicated clients at the firm.
Great, Andrew. And last but not least, Joe Burbella.
Hi, everyone. I appreciate you joining today. My name is Joe Burbella. I am a senior principal in the New York office and a portfolio manager within the Cerity Partners Family Office. I specialize in portfolio construction, customized asset allocation strategies, and delivering tailored investment advice to our clients. Prior to joining Cerity Partners, I spent 10 years at Merrill Lynch in the private banking and investment group.
Great. Thanks, Joe. Well, now that everybody has met the team, why don't we dive into things here? Liquidity events. It is a milestone. It's not just a transaction. It is the culmination of years of work, risk, perseverance, but with all this opportunity that comes out of liquidity events, it creates a lot of complexity. So when we're looking about what to do for a liquidity event, we need terrific planning. Opportunity on one end of the spectrum, you're finally realizing the fruits of your labor. It's going to provide long-term financial security for you and your family. You're going to have increased lifestyle flexibility and certain changes. There's also opportunity here to build your legacy. You have newfounded, unlocked liquid wealth. How are you going to leave that wealth? What are you going to do with it? Are you going to leave it to heirs, charity, that sort of thing? And on top of it, you now have unlocked liquidity to fund new projects, new ventures, make new investments, start something new. So all this opportunity comes with liquidity events. However, the event itself and also post-event creates a lot of complexity. Uh, First and foremost, there is tax exposure when you're talking about a liquidity event, namely federal capital gains tax. There is state income tax ramifications, as well as estate and gift tax. And, income tax versus estate and gift tax, you're kind of talking about two trains running down parallel tracks that you kind of have to look at separately as well as how they work together. Additionally, this unlocked wealth creates brand new financial administration challenges. You're going to be probably putting in place various structures that create additional oversight and the need for additional oversight. Lastly, here, investment management. So your business, assuming it's a business or whatever interest it is being sold, is no longer the anchor asset, and you're going to have new liquidity to put to work. So this duality between opportunity and complexity really raise the question of how are we going to plan for this? And what we're looking at is both pre-event planning and post-event administration. So we're going to be putting together plans that solve for the entire spectrum of a liquidity event. And of course, there's going to be a need to coordinate everybody, all your advisors who are at play, tax, legal, investment, administration, and really the main question of all is who is quarterbacking that? Who is keeping track of all that? So, with this in mind, let's dive into looking at planning for a liquidity event from a high level. So, there are really four main pillars of planning for liquidity events. And today, our goal is to walk through this playbook that will help families and business owners think about these various aspects and these moments strategically. There are going to be estate and tax planning initiatives that you're going to have to look at, and um, mainly, what are the strategies that are required to minimize a tax burden? What are the best vehicles to implement transfers to your heirs and other recipients of your wealth? And who are you intending to provide for? So, while there are a lot of planning techniques that need to be examined, it's also a big question of what are your goals and what are your wishes? This another pillar is day-to-day administration. So there are going to be a lot of various administrative tasks that need to be taken care of, whether it's cash flows, reporting, tax management, really keeping the structure of all that planning, the estate and tax planning that was put in place running smoothly on a day-to-day basis. And of course, you have investment advisory. So your new liquid assets, we are going to need to determine how best to invest those. So as you will hear, balancing short-term liquid needs with long-term growth. And finally, the last pillar, which is really an umbrella that ties everything all together, is holistic wealth management. And the first three pillars, they all need to be integrated. And the question is how and who is going to coordinate all of this? Who is the quarterback of the other three areas? Now, before we get into the specifics of all this, I think it would be good to examine, why are we doing this in the first place? What are the potential pitfalls of not putting this together beforehand? And for that, I'm going to turn it over to Andrew.
Thanks, Adam. We break these pitfalls into three main categories. Two of them are things that occur before the liquidity event. And the first one being the unexpected tax liabilities that you may encounter during your liquidity event. We're all very familiar with capital gains taxes on the federal and state side, but we're also not as familiar with some of the more esoteric and little known taxes that may apply to your business or other liquidity event needs. And so it's important for us to take full stock of exactly what you have on your tax return and the areas that your taxes will be impacted by the sale or other liquidity event that you have going on. This is important to do significantly ahead of the liquidity event and before there's any reason that strategies may be ruled out because of the timing. So we want to anticipate the potential tax bill and figure out what the areas are that you may have taxes due, whether it be New York State, New York City, another state, federal, net investment interest tax. These are all areas that you need to encounter and think about well before the event happens. And once you've encountered those taxes and seen what they could possibly be, there's then the optionality to mitigate those strategies. And that's done through a variety of tax strategies that Justin will speak to at a later date. But it's important to understand those ahead of time and try to do your best to figure out how do we tackle them before we actually get to the point where they're going to be put on a tax return. There's also estate planning opportunities. And this is an area that is a little bit more difficult for clients who are running into a situation where this is their first bite at the apple at having significant wealth. When you don't know exactly when the wealth is coming in, when you have a younger family, you want to make sure that you're defining and providing flexibility to your heirs. You also want to make sure that you're doing estate planning significantly before the liquidity event happens. Sometimes these two things can become very difficult to accomplish because you need to plan without knowing what the actual liquidity is going to be and where you want those funds to go. You may have very young kids. You may not know exactly what you want them to get at later dates. And this is where flexibility is probably the most important thing. And so here in our family office, our main goal is to provide an estate plan that gives you the maximum amount of flexibility while still moving more assets outside of your estate. We've had many people who have come to us at too late of a date on close to the liquidity event happening, and it said things like, I wish I had moved more assets into a trust. This is something that we see quite often, and it's important to understand and put through a thoughtful plan of how to encounter this with our clients. You need to have thought about what the entire balance sheet looks like, what the post liquidity event planning is going to look like, cash flows analysis needs to be done, and a lot of thought has to go into thinking through exactly how you're going to accomplish your goals of moving assets into a trust for future heirs, but also balancing that with your future needs of where you may need to get cash and the things that you want to do with these assets that are going to be life-changing for you and for future generations. The other thing is the sooner you can start on the estate planning front, the lower the valuations are going to be on your business or on your assets that you're moving into this estate plan. When this also means is that they're going to have more tax efficient wealth transfers when you're doing this early. And so the sooner that you can encounter someone who can help you with these aspects, the more opportunity you're going to have to move assets outside your estate and save on estate planning and tax planning. And then finally, lack of liquidity plan. One of the best pieces of advice that I give to my clients who have a liquidity event is don't buy anything large in the first year after you've had this liquidity. It's this type of planning of thought on what are the things that you want to buy? What are the things that you want to accomplish? Where do you want this money to grow for you? It's not just let's put this into a portfolio and have that portfolio grow. You need to think through if you spend $1 million a year and you want to have the income from the portfolio cover that $1 million a year, how are we going to invest that piece of the pie? And maybe you want to take more risk with the assets outside of that to cover future growth. This allocating of cash for lifestyle needs is extremely important to think through before you actually have a liquidity event and have a real plan for how you're going to use that money for yourself and for future generations. Structuring of the investments for growth is really important, and understanding what the asset allocation is going to look like post liquidity event is going to give you the details that you need to provide for an overall plan that's going to align your wealth with your long-term goals. It's this type of planning that you need to envision way ahead of the actual liquidity event. And it's often one of the biggest pitfalls we see from our clients who come to us and don't have this type of plan in place. And that leads into a lot of agita around what's going to happen after the liquidity event, who's going to have access to this money, how is it going to be invested. It's stressful enough to be selling or having a liquidity event where something that you've owned or had an interest in for many years, it's almost like your kid going to college for the first time. You're losing that from your basic life. And now you need to replace that with a plan for how this money is going to be invested and how it's going to be invested for your family and for the future of your family. So these are just three of the common pitfalls that we see and some of the mitigants that we see in order to transact with this situation.
That's great, Andrew. Thank you so much. And how many calls do we get with clients, after they get a letter of intent or a deal is on the table and the contract is signed saying, all right, what kind of planning can we put in place now? That really hamstrings us and it limits our options, which really is a great segue into the next topic here about what are the three stages of a liquidity event and when to start planning and what planning to do when. So the early stage, 3 to 5 years. What planning should we be doing at the early stage? And even it could be even before that. And that's sometimes a really hard thing for business owners to look at is, planning for a liquidity event so far out. And then the pre-transaction planning, 1 year to 6 months out before the transaction happens, before you have your bankers on board, before you go to market. That's when the real meat and potatoes start getting put in place. And finally, your post liquidity event. After the event happens, what is the plan for managing all of those structures and the new investments? So to take us through this and to go into some strategies individually, we're gonna hear from Justin.
Yeah, thank you, Adam. Yeah, so we break up a liquidity event into these three stages because each stage really brings with it different planning opportunities as well as challenges. As Adam and Andrew have talked about, the first stage is early stage, where it's a new company or a newer company. A liquidity event maybe isn't even on the horizon, isn't even contemplated. And the biggest challenge at this stage is just that. Without a liquidity event on the horizon, it's really hard to know what your plans are for any wealth that's going to be created. It's also hard and usually not worth putting in place complicated tax planning structures that are going to be costly to maintain. So the main goal of successful planning at this stage is to do something relatively straightforward that can be leveraged later to layer on some additional and more complex planning. The next stage is pre-transaction. At this point, you know there's going to be a liquidity event. You have a good sense of the value that's going to be created. So it's a bit easier to apply a cost-benefit analysis to a wide range of strategies and determine which strategies make the most sense. In order to be able to do that, as Andrew talked about, it's important to anticipate the tax bill and project just how much and what type of tax will be paid. It's really important, as Andrew talked about, to take this top-down approach, because every situation is going to be different. So until we know how much tax will be paid and what type of tax will be paid, it's hard to assess which strategies are going to have the greatest impact. And it's important to move quick, because the biggest challenge at this point is going to be timing. Everything starts to move very fast and get very busy once there is a liquidity event on the horizon. The final stage is post-liquidity. At this point, the taxes incurred are crystallized, but they're not due, and the actual amounts due are not necessarily finalized, because there are planning strategies to consider after a liquidity event. It's important to assess the time left in the calendar year and the projected taxes due, and move quickly to implement any last-minute planning that can be done. So Adam, if you could switch to the next slide, I'll go through each stage and talk about some specific planning strategies. There are a lot. I'll plan on touching on them high level, but with the primary objective being to paint a picture of the breadth of advanced planning that can be done. So at stage one, our favorite strategy at this stage is to transfer the business interest to a grantor dynasty trust outside of your estate. Andrew talked a little bit about this. The best part about doing this is that valuations are low. So it's relatively easy to get assets out of your estate using very little gift tax exemption. And this strategy accomplishes a number of things. First, it ensures that appreciation of the business interest will occur outside of your estate, so therefore minimizing estate taxes. Second, since we'll create a grantor trust that's disregarded for income tax purposes, that means there's no annual tax filing that's required. And so administration is a little bit lower, and costs to administer are a bit lower. Lastly, we aim to create a dynasty trust that has significant built-in flexibility in order to allow for additional planning to be layered on down the road. This is the most important part of the trust, given the uncertainty of what the future holds, and can make this trust a very powerful tool that can be the foundation for all future planning. I want to give a mention to a couple of other strategies we consider at this stage, and while not widely used, they carry with them some very significant tax savings, so definitely worth a consideration. The first one is private placement life insurance, PPLI. Life insurance in general is an income tax advantage vehicle, and growth within a policy is typically not subject to federal or state income tax. Traditional policies are rigid with regards to what can be held in them, but a private placement life insurance policy is much more flexible and can be structured to hold a business interest. And if properly done, all of the future appreciation of that business interest can occur within the policy, where it will not be subject to any taxes, no federal, no state. So very powerful strategy where it applies. Another powerful strategy is something called QSBS, Qualified Small Business Stock. QSBS is one of the greatest tax benefits the IRS offers, and provides for a $15 million capital gain exclusion. This used to be $10 million, but the One Big Beautiful Bill Act has raised this to $15 million, meaning $15 million of future gains are exempt from federal taxation, and most states will follow that too. Some do not, including California. The challenge here is that it only applies to certain businesses and certain business types. Specifically, the business must be structured as a C corporation, which isn't commonly used for new businesses. And second, the business cannot be a service business. So if you're starting a business that is not a service business, I would highly recommend considering structuring the business to qualify for QSBS treatment. There's some other strategies to consider at this stage too, which I'll talk a little bit more as we go on. So Adam, if you could flip to stage 2. So there are a lot of strategies on this page. As I mentioned, but as we get closer to a liquidity event and we really can understand the tax impact of it, we have a broader array of strategies to consider and have a better appetite for some of the more complex strategies. Our favorite strategy at this stage is to set up a South Dakota non-grantor trust to save on state income taxes. So this mostly applies to people that live in high tax states. Think California, New York, New Jersey, even Massachusetts these days. Often we hear about people considering moving to Florida, Texas, another no state tax jurisdiction before a liquidity event. But this strategy is better because here we're able to move just the asset to a no state tax jurisdiction, and you can essentially stay put. In most cases, we're able to eliminate all state tax that would have otherwise been due. And for people who we've worked with to set up the grantor dynasty trust I talked about in stage 1, because of the flexibility we build into that trust, we can easily move those trust assets to South Dakota as a liquidity event approaches. As we think about other strategies, another state tax mitigation strategy is leveraging pass-through entity tax elections, PTE elections. Ideal is to eliminate state tax altogether with the South Dakota Trust, but if we're not going to go that route, most high tax states offer PTE elections, which allow state taxes to be paid at the entity level and become fully deductible, which currently they are no longer deductible, only to a cap of about $40,000. Now, moving away from state tax planning, the focus is primarily on federal capital gains tax and either reducing it, eliminating it, or deferring it. One of the easiest ways to reduce it is by making donations to a donor-advised fund or private foundation. These vehicles are great because they allow you to front load multiple years of charitable giving into 1 year, while still maintaining flexibility to donate those funds in future years. This provides a great opportunity to receive an outsized deduction in the year of the liquidity event. And the question really becomes, what asset are we going to be looking to donate? Sometimes it's the business interest, but oftentimes it's better to donate some appreciated securities that you may already hold in your portfolio. That's one of the areas that we would look to review with you in terms of just determining what the most advantageous asset is to donate. Another charitable play that offers a charitable deduction, but more powerful because you get to keep a bulk of the funds and can defer taxes, is something called the charitable remainder trust. We won't get too much into the detail, but essentially what happens here is the interest is moved into the charitable remainder trust, and you maintain a stream of annuity payments for the term of the CRAT, usually 5 or 10 years. After you receive the payments, the remaining amount passes to charity. And the great thing about this is that taxes are deferred and only realized as you receive annuity payments. And so this deferral allows time for tax loss harvesting strategies that we'll discuss in a minute to generate tax losses and offset gains received. A similar concept of tax deferral, but without the charitable component, is something called a 453 deferred sales trust. A deferred sales trust leverages the installment sale treatment under Code Section 453 to defer gains until funds are received and utilizes a trust to buy your business interest prior to the liquidity event. This allows gains to be deferred until you actually receive the funds from the deferred sales trust. Now, this strategy comes with meaningful risk and a lot of complexity, so it should certainly be used with caution, but it can be a very useful tool if your liquidity event is happening at the end of a calendar year, when there's not much time afterwards to employ tax loss harvesting strategies to offset gains. For example, anyone who might be having a liquidity event in 2025 should definitely consider this strategy. Now, moving to the third stage of a liquidity event, I don't know if you could flip to the next slide, to post-liquidity event planning. Our favorite strategy at this stage is to leverage a tax loss harvesting direct indexing strategy, whereby we take proceeds of the sale and we invest them in a separately managed account that buys all the individual stocks of a selected index. On top of this, there are long and short positions that are layered on. And so this accomplishes a couple of things. First, it allows you to get your proceeds to work, and it ties the returns to the returns of an index. But more importantly, because we have longs and shorts wrapped around the index positions, the strategy is able to generate tax losses regardless of the direction of the market. This strategy is very powerful, and it can generate losses equal to 60 to 70% of the amount that's put into the strategy per year. So if we have a liquidity event in January and the strategy has a full year to generate losses, we can knock gains from the sale down very significantly. The later in the year the event occurs, the less losses that can be generated. This is where it becomes very powerful to couple this strategy with one of the tax deferral strategies talked about in stage 2. Because if we can spread the gains out over a few year period of time and employ this tax loss harvesting strategy, we've seen instances of being able to wipe out 100% of capital gains realized. Extremely powerful. To the extent gains weren't deferred using one of the stage 2 strategies, it could be worth considering a qualified opportunity zone fund. This is a relatively new strategy that came about in the Tax Cut and Jobs Act of 2017, whereby capital gains can be rolled into certain real estate investments and have those gains deferred. Now, the qualified opportunity zone funds are set to expire at the end of 2026. They've been revived by the One Big Beautiful Bill Act starting in 2027, leaving things a bit in flux over the next year. But that all said, a liquidity event in 2025 can still benefit from this strategy and should certainly be considered. Lastly, another strategy to consider post a liquidity event is something called the charitable lead trust, a similar concept to a charitable remainder trust, but really in the opposite direction. The greatest advantage to a charitable lead trust is that it can be funded with cash from the sale proceeds, and it provides a very significant charitable deduction in the first year. This strategy also has an estate tax component to it by providing charity with a stream of annuity payments up front, and then after the annuity term, any appreciation will pass to your heirs, free of gift and estate tax. So that was a lot of strategies across the various stages. And again, the objective of running through all these strategies isn't so much for everyone to remember the details of them. We will be providing a playbook that goes through them in greater depth after this webinar. But the more important thing to realize, there are a significant number of strategies to consider depending on the stage of the liquidity event that you're at. And they all have potential to significantly shape the outcome of a liquidity event. The amount of taxes that are due upon a liquidity event can be in the millions or tens of millions or hundreds of millions of dollars, depending on the size of the liquidity event. And so the ability to employ one of these tax planning strategies can have the greatest impact of allowing you to preserve some of the proceeds of that liquidity event. Now, switching gears a little bit, once we're through these tax planning strategies and all available planning is done, we start to focus on a couple of other things. One of the first things to think about is regarding the rollover equity. So oftentimes during a liquidity event, not 100% of the business interest is liquidated, and you may have equity in the acquiring company. It's important to consider this equity because any of the above strategies already discussed can now apply to the rollover equity. Though you do have a little bit of time to work through this, it's helpful to do it closer to the event when you have a valuation that you can use, but you certainly have a little bit more time, given it'll probably be a few years from that liquidating. So really the most important thing to be focusing on once we're through these strategies is preserving the wealth that was just created. When we think about preserving the wealth, we really think about this in two ways. First is operationally and strategically. How is the wealth managed? And then second is from an investment point of view. The best solution to managing the wealth operationally and strategically is through the use of a family office. And I'll hand it over to Andrew to talk about that.
Thanks, Justin. The family office solution wears many hats and interacts with all advisors. The way that I like to think about this is a wheel, and each spoke on the wheel represents an individual in your financial life. There's a spoke for your tax advisor, your CPA, life insurance, property insurance, estate planning, investment management, banking, philanthropic. All of these spokes represent the people in your family office solution, but those spokes are not necessarily speaking to one another. And so the family office really serves as the hub in the middle of the wheel to provide the advice to the family and interact with all these individuals to ensure that everything is being done in a cohesive manner. If your CPA is not talking to your investment manager about tax planning strategies like gifting assets to a donor advised fund, where are you going to get that advice from? Your CPA is mostly on the data entry side of your tax return. Your investment manager is concentrating on new investments and performance. There's no one that's going to actually come to you and say you should give appreciated stock to your donor advised fund or foundation. So that's where the family office would come into play to say, by looking at your balance sheet, we can see that you have donor advised fund capability through giving appreciated stock, and not just saying that here what you can actually give, but taking the next step of administratively pushing the easy button for you, picking out those stocks, putting the paperwork in front of you, getting your signatures, and then executing on that paperwork to move those positions. It's the job of the family office to look at all aspects of your financial life, including property insurance and life insurance, two areas that are commission-based brokers that are providing that advice. Who's going to come to you and say, your deductible on your property insurance is too high or too low, and we should give another advice on that property insurance deductible? It's our job and the family office's job to provide central oversight and coordinate all the advisors that are involved in your life. While we do not prepare estate planning documents in-house within the Cerity Partners Family Office, we often stand between our clients and their tax and estate planning attorneys to provide that advice. We want to be the ones who can go to our clients and say, we understand your situation, we understand your family and your kids, and exactly how you want money to flow. And therefore, we can provide advice to you on how your estate plan should be structured. And then we can reach out to the appropriate attorney to get those documents drafted. And then we all have clients who have encountered a situation where they get their estate planning documents drafted. They're 60 pages long, 100 pages long, and they're sitting on your desk for 6 months while your estate planning attorney thinks that you're going to review those documents. Our job is to come in and say, let's put this on 1 or 2 pages. Let's really understand what the decisions are that you need to make here. And then again, on the execution of the documents, it's important to have the right notaries and the right people that are witnessing those documents. And then afterwards, the administration of getting those documents in place is extremely important. And a lot of the times the attorneys tend to disappear after that point in the transaction. So when you're forming this family office, you're looking for governance, accountability, compliance, cash flows being managed in thoughtful ways. And then also there are things like concierge and lifestyle. A lot of the times post-liquidity event, people's lives become more complicated. They own more homes, they have more cars, boats, planes, and this requires more oversight. A lot of the times we end up getting involved on bill payment for our clients because they want to get that time back. And a lot of times the family office on the time savings is actually the most important thing that we can accomplish. Our clients lead complicated lives. They are running really large businesses. They have families that they want to spend time with on the weekends. The last thing they want to do on Saturday is wake up and have to answer tax questions from their CPA and track down 1099s or 1098s. And so it's our job to come in and say, we're going to handle all aspects of this, from your CPA, your estate planning attorney, paying your bills, even down to finding you a reservation at a restaurant or getting you a private aviation to go on your next vacation. And then finally, on overseeing the risk, insurance, and liability management. Once you have more money and more in your accounts, you also have more to lose. And so what are the steps that need to be taken, whether it be through excess liability insurance, property insurance, life insurance, and solving for those needs so that to make sure that you have the peace of mind that your life and finances are in order. It's these type of things that our clients come to us with and want us to sit in the middle of their wheel to provide them the right advice that can give them peace of mind that everything is being taken care of. While we are a family office for all of our clients and we concentrate on investment management as a main part of that, we find that a lot of times it's these other areas that we can provide the most amount of value. It's extremely important that all of our clients understand and all of our team understand that these are the places that we can find value for our clients and providing them with a family office service that saves them time and money and provides them peace of mind.
Thanks, Andrew. Shifting gears a little bit from there into the last piece here, Joe is going to talk a bit about what to do with your new found liquidity and how to invest that.
Thank you, Adam. I'd like to start this section with the idea that liquidity events can significantly reshape a client's balance sheet. And in many cases, it means turning a concentrated asset into cash. With that transition often comes the question of, how do I put that capital to work in a way that lines up with certain goals and priorities? The answer to this question is an important responsibility that our team at Cerity Partners helps clients navigate. One framework that our team uses in answering these questions is what we call the bucket approach. The bucket approach organizes wealth by both time horizon and purpose, and it also layers in tax and estate planning efficiency. The idea with this approach is to balance near-term certainty with medium-term stability and long-term growth. The slide shown here describes the bucket approach at a high level, and then I'll break down each of the buckets in a bit more detail. The framework is made up of 3 core buckets, with the first bucket being liquidity. Think of this as an immediate safety net for the years right after the liquidity event. Usually we think of this period as a 0 to 2 year time frame. This would cover lifestyle spending, taxes, big purchases, or any other known expenses at the time. Investments in this bucket are intentionally straightforward and would usually comprise of cash, money markets, and short-term treasuries. The main point for the liquidity bucket is peace of mind. And what we're looking to avoid is being a forced seller of your long-term investments, particularly in a volatile market, just to cover short-term needs. The second bucket, highlighted in the middle of the slide, is income. This bucket is more of a 2 to 7 year time horizon and is designed to generate steady cash flow while also protecting capital. Once the liquidity bucket is used up, this is where clients can pull from for ongoing expenses if needed. Typical investments in this bucket might be high-quality bonds like core fixed income and municipals, plus private credit, alternative income strategies, or dividend-paying equities where it's appropriate. The main theme for the income bucket is balance, and the goal is to implement a plan that provides income and stability without leaning on long-term growth assets. The third and final bucket of the framework is growth. I like to think of this bucket as the long-term engine of the overall portfolio with a horizon beyond 7 years. It's where families focus on growing purchasing power, compounding wealth, and often supporting legacy goals like philanthropy or wealth transfer. The growth bucket can include global equities, private equity, hedge funds, real estate, really any asset designed to drive growth and outpace inflation. I think one of the most important takeaways from the bucket approach is the realization that every client situation is unique. The framework is intentionally flexible, as the buckets can be replenished, rebalanced, and adjusted over time as circumstances for each client change. This thoughtful approach to us is not just an allocation model, it's really a disciplined structure for decision making. We view it as a way of helping families balance today's security with tomorrow's opportunities, while also integrating thoughtful estate and tax planning. That's a very brief overview of the bucket framework. And with that in mind, I'm going to hand it to Justin, who's going to walk us through a real-world liquidity event case study.
Great, thank you. Yeah, every client situation is unique, but we thought it would be helpful to share the details of an actual client situation to help bring to life the impact of some of the advanced planning that we've been talking about. We had a client engage us. It was about 6 weeks before a liquidity event and about 2 weeks before signing a purchase agreement. So not an ideal time, but when presented with a challenge, we're always up to solving that. And so we needed to move quickly, and I specifically flagged the 2 weeks before signing a purchase agreement because much of the tax planning that we discussed needs to happen before purchase agreement is signed. The IRS has what's called assignment of income rules, where if you do it too late, you're not allowed to assign the income to someone other than yourself. And so this particular client was a founder of a company that was being sold for $150 million of cash and $50 million of rollover equity. They lived in New York City, they were married, and they had already used their exemption to fund multiple existing trusts. And they came to us looking for help to mitigate the tax hit from the sale, as well as to build their family office and manage the proceeds. So the primary challenge was really just was time. So with only 2 weeks before a purchase agreement was signed, we needed to move quickly to review the transaction, come up with a plan, have new trusts drafted, and everything implemented. Fortunately, we're able to move that quickly, and we have a great network of providers that we work with, particularly a trust and estate attorney, Bill Lipkin, who is one of the best in the business and moves very fast, is able to move very fast and provide trust in very short order. And our trust company that we work with, Bridgeford Trust Company out of South Dakota, given the work that we do with them and the amount of time that we've been working with them, they're also able to move pretty quickly. And we handle the actual opening of the various accounts. So fortunately, we were able to get a trust drafted. We were able to get Bridgeford to sign on as trustee and get these trusts created. And so we were able to leverage the existing trusts that are already in place. And so we needed to do some maneuvering to do some substitution of assets. These initial trusts were grantor trusts. So needed to first get the assets into the trust, and then we were able to decant the assets from these grantor trusts to our South Dakota trusts. And we were able to move the interest to the trust prior to the liquidity event. And number one, eliminate all New York State and city tax, which saved over $15 million in state taxes, just completely eliminated them. We also sought to mitigate federal capital gains tax and invested the proceeds into a tax loss harvesting strategy that I talked about. We did this in July of last year. And so even though we were more than halfway through the year, we were still able to generate capital losses of over $80 million, which reduced capital gains tax by over $16 million. And lastly, what we did, we worked with the client to front load about 5 years of charitable giving. They had a history of giving about $1 million per year and moved $5 million of appreciated securities from their existing portfolio into a DAF, which saved roughly $1.5 million in taxes. So all very powerful stuff that led to this client holding on to a significantly more amount of the proceeds than if they had done no planning at all. So, most important is to come to us and talk to us about your specific situation, your specific liquidity event. Let us do an assessment of the taxes that are going to be due and figure out what are these strategies that are going to be most impactful to you and project the amount of tax savings that could come from it and to see if it makes sense to put forth any of these strategies. So with that, Adam.
Thanks, Justin. That's for me at least, it's when telling a client this is what we're going to save you on your tax bill, seeing the smile on their face is the reward. Um, so let's close things out here before we get to some question and answers. So thank you everybody for joining us and listening to us. So as you can see, thoughtful planning, addressing your liquidity events early before they become, a problem, is the way to go. We want to be looking to reduce taxes. We want to be looking to position you for your long-term legacy, to provide growth. And we want to be in a position where everything is being coordinated properly. Somebody is quarterbacking the entire process, whether it's the planning before the liquidity event or whether it's the post event administration. So everybody's situation is unique. We understand that. If you ever want to speak to us or to model out the impact of a liquidity event, and we can go through what a tailored plan would look like, please contact your Cerity Partners advisor or contact CP Family Office at ceritypartners.com. And I think there are a few questions in the chat. Let's take a look here. Oh, this one's good for Joe. Hey, Joe, how do you think about implementing an investment plan all at once or over time?
Um, that's a really good question, and I would say that question pretty much comes up in almost every liquidity event we advise on. The reality is there's no kind of one size fits all answer. It really does depend on each client's individual situation. There's generally two broad approaches that I would speak to. One is, of course, investing all at once, and then the other is phasing into the market over time via a dollar cost averaging strategy. I would say, investing all at once gives your money the maximum time in the market, which historically has been a strong driver of long-term returns. But on the other hand, dollar cost averaging, I think certainly has its merits. Dollar cost averaging can help smooth out returns and the entry point of your investments. And I think it's also very worthwhile to mention that it could just simply provide peace of mind in volatile markets for our clients. So, I would say for most families, we tend to use a combination of both. We may often allocate immediately to like the shorter term liquidity or income needs, since those assets are typically meant to be more stable. And then for longer term growth assets, we may implement a dollar cost, averaging plan over several months. The last point I will make, and Justin brought this up earlier in the presentation, there's certain tax-aware investment strategies like the long-short direct indexing investments, where maximizing the time invested during the tax year of the liquidity event is vital. So in those instances, we typically invest all at once to help maximize realized losses for our clients.
Thanks, Joe. Let's see if we can go to another question here. Okay, this one's a good one for Andrew. We've relied on the family business to handle much of our financial administration over the years. How is a family office able to replicate that?
Sure, it's a great question. A lot of the times we encounter clients who are having liquidity events and their family office needs are being handled within their firm, whether it's a family business or they've have other advisors that they've structured that are doing parts of the business. And so it's important for us to get in there and take a top-down approach of exactly what is being done, and then also figure out what needs to be done going forward. As I mentioned earlier, I think bill pay is one area that is most often being handled on the financial administration part by the family business, and taking that out and understanding all the things that are being done internally, and then taking that out and putting it into our own format of how do we then replicate what is being done in order to make it as smooth for the family so that they don't see any breaks in their water being turned off at their vacation house or invoices not being paid. So it's important to understand what is being done internally and then what we can take outside from that and handle ourselves. We come from a place of yes in almost all circumstances. And so whatever it is that our client needs are, we're going to find a way to accomplish them. It's just a matter of figuring out the most efficient way to do so. And I think that there's a lot of coordination that needs to happen, especially in the family business situation, where the family business is not going to be doing those things on a go-forward basis. The acquirer doesn't want to have the bill pay person or someone who's doing investment tracking or balance sheet tracking for a family. We pride ourselves on our ability to take whatever our client situation is. We don't put our clients in a box. Our clients come to us and say, these are the things that I want. And it's our job to go to them and say, here's how we accomplish those things. And we can do all of that in-house, internally, within the Cerity Partners Family Office. And we have a full team of people. We have 7 full-time bill pay people, on-staff CPAs, estate planning attorneys, person that fills out subscription documents. It really is a holistic team that covers our clients. And it's through this whole team that allows us to be able to handle all aspects of whatever the family has going on.
Thanks, Andrew. And if ever our internal experts don't know the answer to a question, we get it. So let's take a chat. Justin, do you have a good question that you
Yeah, so someone had a good question. Are there any tax benefits that are sunsetting under the new tax bill that we need to be aware of, or are you planning on substitutions to preserve assets? I'd say one of the biggest takeaways from the One Big Beautiful Bill Act was that not too much was changing. While there was a lot of talk about how it increased budget deficits, that was really because there were a lot of benefits that were expiring in 2026 that are now no longer expiring as a result of the One Big Beautiful Bill Act. So, really not too many changes. Now, in the fact that there weren't too many changes really is where we see some planning opportunities. So, for example, state and local income taxes, they're currently not deductible. Under the Tax Cut and Jobs Act of 2017, they were supposed to become deductible again in 2026. So it really limited or put some water on, some of the state tax mitigation strategies that we talked about. Now knowing that they will no longer be deductible, until there's further congressional action, it places greater emphasis on doing something like South Dakota non-grantor trusts or some of the PTE planning that we talked about. One of the other benefits I mentioned a little bit is QOZ, Qualified Opportunity Zone funds. We were, so back in the Tax Cut and Jobs Act, they were set to end in 2026. We were all hoping that expiration would get extended. It did not. However, there was a new version of Qualified Opportunity Zone funding that was put in place, essentially creating a rolling 5-year tax deferral. Now, this only applies starting 2027, so not too much help for us now. And as I mentioned, given the fact that it expires in 2026, there is still planning that we can do in 2025 to leverage this benefit. The other thing in terms of the new tax bill that I'd say in terms of strategies that came about from a lack of change, there was also concern that the estate tax exemption was going to get cut in half. And so there was a lot of discussion about accelerating gifts to use up that exemption before it was cut in half. The new bill did not cut it in half. It actually raised it. And so starting in 2026, that exemption is going to be $15 million per person. So a total of $30 million for married couples, unless you've used some of the exemption in past years. Now, the estate tax rate has stayed the same at 40%. And so it has really placed a renewed focus on doing estate tax planning. So anyone with a taxable balance sheet of greater than $30 million should certainly be considering some aggressive estate planning strategies to get the appreciation and reduce your taxable estate to below that $30 million level. Outside of those strategies, there was talked about some changes to QSBS that are helpful in that regard. Another thing that has come about from the new tax bill is a reduction in itemized deductions. So there used to be this PEAS limitation after the senator that came up with it, PEAS, PEASE, that limited itemized deductions by about 2%. That went away with the Tax Cut and Jobs Act. Now, with the new tax bill, there was a new introduction of itemized deduction limitation with a further reduction to charitable donations. And so that all starts in 2026. The amount of the reduction in that benefit is going to vary depending on your income level. And so what we would say is you look to potentially accelerate donations to 2025, again, using a donor advised fund or private foundation. To the extent you can't use that full donation this year, it does roll over. Now, the reductions are not meaningful enough that we're sitting here recommending to clients to accelerate these deductions too significantly. But if you had plans of making a large amount of donations in 2026, it could very well make sense to accelerate those deductions into 2025 to get that full tax benefit. Other than that, I'm not think there's not too much else that's going to be sunsetting, and so everything that we talked about here today is still going to be applicable going forward.
Thanks, Justin. I think that leads us perfectly into the last question here. What happens if tax laws change or the family's goals change? How much flexibility is built into, some of the structures that you discussed? And I'll take this one if you don't mind. Tax laws do change. We saw a tax law change in 2017. Justin was just describing some changes to tax laws. So we have to plan with flexibility in mind to be able to adjust that. And really what we're talking about here is when you're gifting assets to trusts and you're basically parting with those assets and now they're in trust for your family and for the future. Clients look at it, two different things. First is, well, what if I ever need those assets? Can I ever get that back? And then secondly, what if something happens with my family or the tax laws change that we need to kind of pivot in the future? And so two kind of questions there. The first is that trusts are now designed where a spouse is a beneficiary, for example. So, to the extent you ever needed access to a trust or the trust assets, which would be the last bucket we would recommend taking assets from, because they are out of the estate, it's better to spend your own assets first. The spouse could get a beneficiary. Get a distribution rather, and then the grantor, the person who sets up the trust, has backdoor access that way. In addition, states like South Dakota, Alaska, Nevada, Delaware have domestic asset protection laws in place, which say that you, as a grantor of a trust, the settlor of a trust, you can establish a trust and actually be a beneficiary of that trust, and creditors can't get at your assets if certain requirements are met. And because the fact that your creditors cannot get at your assets, that means all of this great estate tax and income tax planning is still available with you as a beneficiary of the trust, able to receive a distribution in the future if ever needed. That is relatively new and only came into existence starting around 1997. And then on the back end, what happens if something changes with the family? What happens if the terms of the trust need to be changed? What happens if the wishes of the family need change and we need to kind of pivot? Um, Setting up an irrevocable trust doesn't mean it's not changeable, it's not modifiable. It simply means you, as the person who set it up, can't freely just go in and grab the assets and take them back. So there is this concept called decanting, and it's just like decanting wine. We're going to pour the assets out of the old trust into a brand new trust with new terms that meet your new family goals. And we build this flexibility into the trust. And Justin mentioned this a bunch when he was going through the various techniques that we do. We build this flexibility into the trust to be very broad and to be able to kind of adapt and pivot as needed. And we do this, day in and day out. We are constantly addressing families wanting to change how their trusts are structured. So, with that being said, I think we'll close out here and thank you all for coming. Andrew, Justin, Joe, thank you for presenting here today, and we'll see you. Please give us a shout if you need anything.